In Roman mythology, Salus was the goddess of health and well-being, a fitting name for a company bringing healthcare from principles to the consumer across Central and Eastern Europe. We're from the University of Ljubljana, and it's our pleasure to present our modern incarnation. Salus is a blue-chip stock listed on the Ljubljana Stock Exchange, for which we issue a hold recommendation with a target price of 64.5 euros, representing a 3.2% upside as our valuation date of May 1st.
Salus is a Slovenian distributor of pharmaceuticals. On the value chain, they're positioned between the principal companies, so the pharmaceutical manufacturers, and hospitals and pharmacies. The group is present in 17 CEE countries, and by that covering a natural pool of Eastern European region, although 95% of the revenue is still coming from Slovenia. In 2025, Salus had revenue of almost 700 million euros, representing 11% CAGR over the past 5 years. In the recent year, their stock experienced 3 significant events. First one was stock split 78-1 in June that increased the liquidity of the stock. The second was an acquisition of another wholesaler in Slovenia. And the third one was the inclusion of Salus' stock on Ljubljana Stock Exchange Blue Chip Index. Looking at their business model, is split into 3 distinct segments. First one is wholesale, where Salus operates as a pure logistics provider, moving goods from point A to point B. This is the cash cow of the business, representing almost 80% of the revenue. Salus is operating as a wholesaler only in Slovenia and has 2% regulated EBITDA margin. The second segment is retail, where Salus owns and operates a chain of non-regulated over-the-counter pharmacies. The chain was acquired in 2018 and is operating in Slovenia and Croatia. The third and most exciting segment are partnerships. In this segment, Salus takes over a larger chunk of commercial operations from its principals, so not only logistics like in wholesale, but also marketing, sales, and regulatory affairs. For these services, they are awarded with a higher 20% EBITDA margin. To further inform our investment thesis, we conducted 4 additional research approaches, among other expert interviews, team sentiment survey, as well as the tone analysis of the AGM and the consumers.
Domestic wholesale market operates as a duopoly between Salus and Chemopharmacia, relying on strong relationships with principals, hospitals, and pharmacies. In retail, Salus faces competition from both public and private pharmacy chains across Slovenia and Croatia. And in partnership segment, Salus is a small player against big international distributors, leveraging its regional expertise to fight for principal contracts. Recently, several principals withdrew from the CE markets, leaving a gap that is being filled by regional hubs like Salus through partnerships. Over the past 5 years in Slovenia, total packaging volumes and value grew by 3 and 10% respectively year over year. And within that, rare and chronic medicine segment outpaced the broader pharma market with 31% volume and 20% value CAGR. The demand is rising with the growth of the 65-plus population cohort and their increasing consumption of medicines. More than half of individuals in this category suffer from multimorbidity and polypharmacy, leading to steady structural growth in healthcare expenditures reaching over 3,000 euros per capita in Slovenia in 2025. Prices and margins are tightly regulated by public domestic institutions, and with the majority of medicines costing over 50 euros, Salus's wholesale margins are effectively kept at around 2% and even lower during inflationary episodes. Our expert at Health Insurance Institute of Slovenia highlighted that they consistently negotiate medicine prices down by an average of 7%.
Looking to the ESG lens, the most material aspect for Salus is their reputation with the principal companies. When principals are looking to outsource their commercial operations, they evaluate Salus and the partners on certain criteria, and ESG aspects are becoming increasingly important. To simulate that, we conducted our own team's ESG scoring that was based on the principal sustainability strategies, expert interviews, and team sentiment survey. And on this scoring, Salus is placed mid-pack. We integrated that into our valuation. On the free cash flow side, we modeled additional expenditures for green transition over the next 8 years. And on the discount rate side, we added ESG premia to the cost of debt to simulate the transition risk. Looking at their environmental point of view, Salus's main drawback is not having science-based targets in place, but on the other hand, they are the first CEE operator to fully deploy an electric van and are showing increased investments in this area.
Recently, revenue growth was driven by successful M&A activity. Looking ahead, we project revenues on a segment-level basis. Due to duopolistic position on Slovenian wholesale market, we expect that Salus's wholesale business will grow in line with macro-demographic trends and healthcare expenditure. For retail segment, we forecast that the growth will be primarily driven by gradual market share gains in the Slovenian OTC segment, and overall, it will be in line with European peers. For partnership segment, we assume incremental growth based on historical performance, reflecting the nature of the market, where companies typically start with smaller contracts and scale them over time. In addition, our forecast also incorporates selective M&A activity for this segment. Overall, we forecast that margins will be there will be margin growth in the forecasting years, mainly due to changes in revenue mix. Looking at the net working capital, we expect that liquidity drag will persist. This is also consistent with management assessment. This all comes from the fact that Salus is structurally squeezed between inefficient Slovenian healthcare system, which cannot pay Salus in time, while on the payment side, Salus has principal, to which they cannot stretch payment terms. Additionally, on inventory side, Slovenian regulation on minimal inventory level puts additional liquidity burden on Salus. To bridge this liquidity gap, Salus is relying heavily on revolving credit facilities in the recent years, increasing their interest expenses. However, in 2025, interest income on overdue receivables rose significantly, so overall, net finance result turned positive. Looking at the balance sheet, Salus is low indebted company compared to peer levels, which provides meaningful strategic flexibility going forward.
In DCF, our evaluation is based on segment-level forecasts over 8 years. We modeled net sales growth to slow down to 6.6%, while EBITDA margin to expand from 4 to 5.4% because of the faster growth in higher margin segments. We estimated levered beta using 4 different approaches, choosing bottom-up method of 0.41 to use in our evaluation. Despite being seemingly low, it is in line with consumer staples beta in this specific industry. In weighted average cost of capital, we added liquidity and size premium of 25 and 55 basis points respectively, and terminal growth rate was chosen as most conservative one among 4 different methods applied. This produces DCF value of 63.3 euros. In relative valuation, we built peer universe of more than 30 companies, retaining only those scoring 10 points or more across geography, product mix, business model, and size. Using average EV/EBITDA and price to normalized earnings per share, we obtained fair price of 65.7 euros, including position premium and liquidity discount. We used 5 different valuation techniques, but for target price calculation, we applied 50-50 blend across DCF, which offers us a look into the future, and relative valuation, which gives us current market snapshot to get to our target price of 64.5 euros. This indicates that stock is currently fairly priced on the market at 62.5 euros, therefore we are issuing hold recommendation. We simulated impact of adverse and improved economic conditions to derive a bull and bear case scenario, getting price range between 48 and 90 euros. By changing general DCF assumptions and company's driver structure, we identified that our valuation model is most sensitive to changes in weighted average cost of capital and EBITDA margins, indicating these are the 2 primary sources of upside and also downside valuation risk.
Looking further at the risks, the stock's liquidity has improved, however it remains constrained by the Ljubljana Stock Exchange. Salus has also expanded in the region, but is still concentrated. Their wholesale is still squeezed in. Recent global events point to rising inflation, which increases costs, and Salus is unable to pass these through fully due to margin regulation, which has not changed in over a decade and is unlikely to ease off. We also see that Salus has some past collusive practices, which may present a challenge for more ESG-sensitive investors. Overall, Salus is still primarily a wholesaler, which benefits from demographic tailwinds and a dominant position on the domestic market. However, they face inflation and unforgiving regulation. In response to this, they have diversified into higher margin segments, where they're especially well positioned for partnership wins. Based on our analysis and additional research approaches, we issue a healthy hold recommendation. Thank you very much.
Thank you for the presentation. My question to you is that couldn't the deregulation be a big catalyst? Because globally the markets are moving towards deregulation. So if the pricing is deregulated, how would it impact your recommendation?
Yes, thank you very much for your question. We also talked with expert at the regulator body, and they said that they do not expect nor will change the regulation regarding margins in this sector in the future.
I would also maybe point out that this regulation in Slovenia has not changed since 2010. And like my colleague said, they do not expect this regulation to change.
Oh, thank you for the great presentation. So maybe just as a follow-up, as you're modeling the company, given that it has regulations on price, how does that then translate into margin expansion? I think you mentioned you're expecting the margins to grow going forward.
Thank you very much for the question. We must consider that the regulated part is just the wholesale part, but Salus operates also in the partnerships and retail where margins are not regulated. And because of the faster growth in the retail and partnership that we are seeing also in the past, these margins on the group level will improve, but we do not see the revenues to improve significantly into the future.
In terms of the contracts going forward that they hope to win, so who is their biggest competition when that, I think you said some of the big players are exiting. Is it another regional player or is it somebody global?
These are mostly international competitors. We actually have a slide for that for the major partnership contracts and this one as well. Here we can see that a lot of these, for example, are based in Switzerland, Austria. We have one in Slovenia. However, most of the competition for these contracts in Central and Eastern Europe tends to be outside of the country, so international competitors. They're also significantly larger than Salus. Salus is still a rather small company in the partnership segment. These, for example, are some of the largest deals that have occurred in recent years. The Swix Sanofi one, for example, is the unicorn, so to speak. But again, usually in this segment, contracts are scaled over time. So Salus is still growing the segment gradually.
So then how does it compete when it goes to find a new contract?
So it competes in two different ways. The first way it competes is through the actual nature of the partnership segment, because due to a conflict of interest, a partner is unable to represent more than one drug. So let's say Salus takes on a principal, they are unable to take on another drug from another principal that competes with the one they already have. This means that, again, outsourcing is still very much an open pool of contracts for Salus. But we also see, if we take a look at question 6, based on our sentiment survey, we expect outsourcing to further increase going forwards. Salus also has a 50-plus year relationship with these principals, mainly through wholesale. However, we believe that this can translate well into their partnership segment too.
What could be specific triggers or events or KPIs that would change your rating from hold to either a buy or a sell?
Thank you very much for the question. We here see many multiple reasons why we would change from the hold to buy to the sell. The first one, to the sell. We would change to the sell if this regulation on the wholesale margins would change into negative, but the probability of that is very low because it has not changed in the past and we do not change in the future. The other reason would be the private pharmacies through the online channels would offer much stronger competition into the future for this retail arm of the Salus. And the most important maybe why we change to sell if this new venture, maybe not venture, but the new expansion into the partnership segment would fail or they could not secure new contracts. Whereas for the buy, we would issue a buy recommendation if Slovenia regulation would change to the regressive wholesale margin calculation that is adopted by most of the European countries, or if the public pharmacies keep losing share compared to the Salus. And the data we have obtained through our own analysis that these public pharmacies have lost around 311 basis points in the past years. And the other reason for the buy would be, of course, if Salus is really successful in these partnership contracts, which we would see is uniquely positioned to be in that position.
But none of the variables is a high probability in your opinion, right?
No, none of this is high probability because, as I have explained, these partnerships as well as pharmacies, there are many variables that affect such cases.
It seems that you kept the EBITDA margin relatively stable for all three segments, but the group margin expanding due to mix shifts. Can you explain more why you used that assumption?
Thank you very much for the question. Why we used the margins flat across all three segments are three different reasons. For the wholesale, we kept margins flat as already explained because there is regulation that has not changed. In the retail, why we kept margins flat is because we see on the one side public pharmacies that are losing market share, but on the other side, private pharmacies that are gaining or maybe offering much stronger competition. But for the partnerships, we kept the margin the same because the contracts, these partnership contracts, are very heterogeneous. Therefore, it is, let's say, better to keep margin the same on the same level as they were in the past, and not to expand or do lower margins because of unavailable data.
And why would the group margins grow? Because as we can see here, the wholesale part, which is the lowest one, has the lowest revenue share, has the lowest margins, while the other two high margin activities has the highest growth forecast.
Kind of along those same lines then, are there synergies over the long term that you expect from owning the three different business?
Yes, thank you for your question. We do synergies across all three segments. The main synergies are first the same procurement. The Salus shares the same procurement from the retail as well from the wholesale segment. The other synergy would be same distribution lines. They need to put these drugs from point A to point B, which means the distribution lines for the retail and wholesale segment are shared. Maybe most important is the relationship network. Salus operates as a wholesale for many, many years now. And what does this enable Salus is they have long-standing relationship with the principals that may leave these markets into the future. That's why they are uniquely positioned to win such contracts if the principal leaves our markets.
You mentioned that after the stock split, the stock has become more liquid, but still, are you applying some liquidity discount? And what is that if you are applying it?
Thank you for your question. If you can go to slide V25, we applied 25 basis points premium, and that 25 basis points premium is based on Amihud and Mendelssohn literature, which found out that companies like Salus that would have a bid-ask spread around 1 percentage point higher than reference rate would get 25 basis points, or investor would require 25 basis points higher return. Therefore, we use 25 basis points here, which penalizes the stock by exactly 5%. And this penalization of 5% we also used in the relative valuation to have the coherent valuation model.
Can we go to the relative valuations, please?
Yes, of course.
What has the historical dividend payments been like for the company, and what are your assumptions going forward, given the segments they are looking to focus in?
So Salus has been paying dividends for over 30 years. We have also conducted a dividend discount model, but we did not include it in our valuation because we see that investors right now tend to look more at the capital gains than the dividends for this company. They pay out at least 50% of their income as dividends, and we expect that to continue going forwards to not send a negative signal to the market. However, they have not been paying as much as they could have, preferring to reinvest that into other areas such as M&A, reinforcing again why we didn't use this in our valuation.
In terms of what the retail market is like in Slovenia, owning a retailer in the US, obviously, it's incredibly competitive. So curious what that's like in Slovenia and, um, is it just I think I saw that it was more a pharmaceutical rather than having a broader line of products and, just what do you see going forward for that market?
So yes, it's OTC. That means it's no RX drugs. They also have some OTC medical devices. And yeah, as you can see, they face public and private competition. We did assess, if we go to the consumer analysis, we did assess how they are positioned against their competitors. Yeah, by using some peer-reviewed frameworks to assess some Google reviews, which we scraped for Salus's retail arm as well as competition, and we found that they are more or less in line with them. That's also why we assumed that growth will be more or less in line with peers going forwards for this segment too.
And that is used exactly in valuation, where we converge this revenue growth exactly towards peers at 10% target growth in 2033.
How do your valuations compare to market consensus on the stock?
Thank you very much for the question. There is no market consensus in terms of analyst coverage because Salus does not any analyst does not cover Salus stock. But we did our own analysis. If we can go to the slide V56, you can see here that our perception of the stock is different than what market assigns value to. We see wholesale as overvalued because there is regulated margin and no potential expansion or growth, whereas retail and partnerships are much more undervalued or hidden gem. And the reason for that is, if you can go to the annotated stock, you can see here what the market reaction was at the acquisition of Pharmadent. Pharmadent is a wholesaler in Slovenia with which Salus basically became a duopoly, and markets really strongly reacted to that. But we do not see much potential in this wholesale, much more in retail and partnerships. Thank you.
Do you think that the company could be up for a acquisition by a competitor, and how would it change your rating?
Yeah, only two segments. So partnership and retail segment could be offered through the curve out because there are much larger growth opportunities, while wholesale, as of now, we think that it's not appropriate target for any further acquisition by the competitor.
Yes, maybe I would like also to point out that we did our simplified leverage buyout model. Would Salus be attractive for maybe private equity or strategic investors? And the only reason we may see that Salus, as my colleague already said, from the partnership and retail segment, could only be interesting for maybe the strategic investor. The reason is that, as you can see from the private equity cash flows, most of the cash flows comes at the end, since very low EBITDA and potential to growth limit the potential dividend payouts throughout the years. Thank you.
You mentioned you interviewed some direct competitors. Um, did they indicate any willingness to further cooperate on price, or would they push, and destroy the duopoly? And yeah, any risk there, or can you elaborate a little bit?
Yes, thank you very much. First, to answer your question about the duopoly. So, Slovenia already has some antitrust laws in action to prevent this. However, Salus was allowed to get into this position because the Pharmadent was operating with a loss. And this market is characterized by high volumes. So, Salus was allowed to do this. Now, to ask what was the first part of your question, could you perhaps repeat it?
Yeah, what's the outcome of the interview in terms of, their competitive direction?
Uh, so
We must first understand that in Slovenia, the laws are such that the pharmacies, which gets the drugs from the wholesaler like Salus, are limited to only 70% they can order from